Good evening, everybody, and welcome to Solutions to Help Avoid Foreclosure. My name is Parker Roberts. I'll be co-hosting tonight's webinar with our awesome short sales specialist, Linda Robinson. I spoke with a lot of you before tonight's webinar, and I'm so glad to see that you're all on here tonight. Before we begin, I just want to make sure you can all hear me. If you can be so kind and please type in the chat bar, where you're from and just if you can hear me all right. All right, it looks like you all can hear me fine. Thanks for typing in. As I mentioned before, I'm Parker Roberts. I'm a licensed real estate agent. I hold my degree in finance from the W.P. Carey School of Business at Arizona State University. I'm also a real estate investor myself. My title here at Marshall Reddick is the transaction coordinator. So you may be asking yourself, what does that even mean? Which is fine, I get that question a lot. I basically work closely with our real estate advisors and to understand your needs as a client and as an investor. And I work closely with our preferred vendors to ensure peak performance for your real estate investments. Now, when thinking about real estate investing, I encourage you all to have the mindset of a business owner. In any business, there's three very important roles. There's the CEO, that's the boss of the portfolio. Make the decisions for the greater good and surround themselves with individuals that share the business's goals. And there's the director of operations. They report to the CEO, bounce ideas off one another, provide useful guidance from their experience, and help create a plan of action to achieve the business's goal. And then there's the CFO. They're responsible for financing the business by using leverage for the portfolio's advantage. Now let's think. Who would be the CEO of your portfolio? Now I'm sure you all are pointing at yourselves like I am, or your spouse. Let's take it a next step further. Who's the director of operations of your portfolio? Well, that could be Marshall Reddick Real Estate here. With our company's experience and great specialists like Linda Robinson. And there's a CFO. We have our preferred lenders who can help you with your residential conventional financing needs, or we have our in-house private financing division for your private financing needs. Now let's take a look at an example here. On the left-hand side, you'll see the short sale example. So you've maybe bought this home in 2007 from $400,000. Current market value today in 2016 is $294,000, but your mortgage on it is $372,000. Now that's a difference of $78,000. Now let's take it on option B. You can pay out of pocket. Remember, this is a business decision. Same home, the loan amount is $303,000. There's a difference of $9,000. You say, hey, I can have $9,000. I can pay that out of pocket. But remember, there's closing costs involved. You have your seller's agent commission, your buyer's agent commission, title and escrow fees. At the end of the day, you're looking at about $20,000 closing costs and commissions paid, and then out of pocket, you're looking at $29,000. So again, remember, think of it as a business decision. Now here's how you can really analyze how to take it to the next step. Think why you need your credit. Credit is there to qualify for major purchases. You're going to make a major purchase soon. Maybe you're going to buy a car, you're going to buy a primary residence, or another investment property. How much is your credit costing you? Maybe you have a investment property that is negative cash flow on a monthly basis. You have to think, is this worth ruining my credit or my negative cash flow? And then think, how far underwater is your property? You're going to have to discover the market value. Now Zillow's out there and is great at certain things, but obtaining the market value is not one of them. Give me a call, shoot me an email. I'd be happy to help you find the value of your property. Now what is your plan today? This ties into your goals. Are you going to retire in 20 years? Would you like to retire in 10 years? Are you looking to buy more real estate for that retirement? You really have to think about your goals and what's best for you and your family as well. Are Are you looking to refinance a property? Credit's huge in refinancing properties. Are you going to buy a new car, what I touched on earlier? Anything you need credit for, give me a call, let's discuss, or give Linda a call as well, and let's put a plan of action in place. Now, before I bring up Linda, I want to let you all know we welcome all your questions during the presentation. There is that chat bar on the right-hand side. I will leave some time at the end for a little Q&A for all your questions too. So now I'd like to introduce you to our main speaker for tonight. She has successfully gone through more than 300 short sale transactions. She actually started with Marshall Reddick as a member back in 2004, and she began working with our clients on short sale loan modifications in 2011. Now, without further ado, I'd like to present Linda Robinson.
Well, good evening, everybody, and thank you, Parker. It's always a pleasure to talk to the members because, you know, I am one. And for me, like Parker said, I started in about 2004, and it was real estate was still going really well, and I bought a property in Florida, and I bought a property in Cheney, Washington, and I bought another one in Florida. And the first one that I bought in Florida, oh, it was unbelievable. I mean, in California, the prices were like sky high, and new construction in Florida, like $130,000 for a 4-bedroom property, brand new construction with a lanai near a lake, and unbelievable. The following year was in Cape Coral, and it doubled in 1 year. So it went from like 130 to 268 in 1 year. I said, this is fabulous. This is going to be my retirement. I am so excited. And so what I did was I pulled some money out of it, and I bought 5 more. And the second one that I had bought was in Lakeland, Florida, and that one was a little bit slower. It actually took 2 years to double. I said, gosh, at this rate, I am going to have a wonderful flush retirement, and I was just so excited. I thought it was the best thing ever. And then what happened? Well, at the height of my problems, I had 14 properties, and I was actually putting out about $5,000 a month. Well, it made more like $3,500 a month, because I know it was $50,000 that year on our taxes that we actually put out of pocket. And I looked at my husband and I said, I think something's wrong with this. I mean, these are supposed to be our income-producing assets, and it actually cost us $50,000. And I'm going, okay, well, the good news is it's a write-off, you know, but it certainly didn't justify a $50,000 expense. And like Parker said, you know, when you look at it as a business, and as a business dealing, you just go, now, does this make business sense? And then something really awful happened. Was my husband, who was in construction and was the customer service manager for a major builder here in California, in the desert actually, and he got laid off because the company went under. And so now I couldn't even paid the $50,000 to keep these properties afloat, even if I wanted to. And so is everybody hearing me okay?
Yeah, everybody can hear. I'm getting some good feedback from the chat bar.
Okay. All right. Anyway, just making sure that you were all there. I wasn't talking to here.
Go ahead and hit show my screen at the top.
Oh, okay. There we go. Is that good? All right. So can I continue, Parker?
Yeah, perfect.
Okay. Okay, very good. So once my husband got laid off, there was no way that we even could have paid the $50,000 or whatever it was going to be the next year for me to keep these properties afloat. I mean, it was crazy. And so I started on a process of looking at what to do. And you know what? We weren't sleeping at night. I mean, both of us would wake up in the middle of the night just like shaking because we were in so much fear of our finances and what was going to happen. And especially, like I said, once he got laid off, it was just a really, really challenging time. And so I decided to make a business decision and let go of most of the properties. And over the next 2 years, I short sold 11 out of the 14 of these properties. And I'll tell you what, I sleep like a baby at night now. And you know, yes, of course it was a difficult choice to let go of my 800 plus credit and to get rid of the idea that these properties were ever going to really be my solution for retirement, like I was hoping that they were, and that all of the money that I put down in down payments and repairs and all of that were just wasted money because I wasn't going to recoup a dime. And it was a challenging thing to make that sort of decision and to get past those emotional components. But, you know, like we said, it's a business decision, and the idea of throwing good money after bad is not a good business move. And so I just had to do it. And it's kind of crazy. The first property that I actually short sold was a property in Lehigh Acres, and I bought it for $140,000. And it was a construction loan that was supposed to actually get sold before I wasn't even supposed to even have a permanent loan on it. It was just supposed to be a construction loan and then being sold. And the market tanked. And so it couldn't even be sold for what we paid for it in construction. So I had to end up getting a permanent loan on it. And it was actually $1,400 out of pocket each month. And the thing is, we had a tenant there paying $850 a month rent, but, you know, our mortgage was a lot higher than that. But here's the good news. Somebody actually bought that property for $35,000. It was 1 year old, had a tenant in there for $850 a month. Somebody bought that for $35,000. Now, is that a good deal for them? Oh, yes. You know, it was certainly not a good deal for me to keep it, but it was a great deal for them to buy it. And I got to sleep better at night. And then another one of my properties that was in Cheney, Washington, it was actually one of my best properties. It was like a $300, $400 a month positive cash flow every month, year in and year out. I had it for like 3 years, and it was doing wonderfully. And then we lost the tenant. And for some reason, they couldn't re-rent it. We kept on lowering the price, and they couldn't re-rent it. And so 10 months later, after putting the mortgage out of pocket for 10 months, all of my surplus on that property that I'd made $300, $400 a month for 3 years, all of that surplus that I had banked in the account was gone. And I decided I needed to short sale that property. So it's all kind of been like that. But like I said, right now, I sleep really well at night. And it also, the good news about all of that is that I'm a person that really always looks at how can my bad experiences help others. And so when I got connected with Marshall Reddick network and proposed my services as a short sale negotiator, it was to help all of you guys that were just like me and in the same boat as me, and that I had to muddle through it on my own, and I'm able to help walk you all through it. And so you don't have to be there on your own. I can hold your hand every step of the way, and at this point I'm really good at it. I've done over 300 short sales, and I have relationships with all of the major lenders, and they like working with me because I'm respectful to them. I'm non-confrontational, like some of the attorneys that they deal with and stuff, and I always get the best deals I can for my clients. So what is loss mitigation? Well, it depends on from whose perspective you're looking at it. The banks think that loss mitigation is mitigating their loss. You know, I think that loss mitigation is mitigating your loss. And so, you know, that's why it's important to have a specialist working with you, because I'm going to fight for you. If you do it yourself with the bank, you know, whether it be a loan mod or a short sale, you know, as helpful as the bank is, they're looking to mitigate their loss. And so you always need to have someone on your side. So there's several types of loss mitigation that we're going to talk about. The first one is loan modification. And that, of course, is a process where the terms of the mortgage are modified outside the original terms of the contract that was agreed to by the lender and the borrower. And it's different than a refi. You know, a refi is also where the terms of the mortgage are modified, but that's an actual going through another loan. And you have to have certain qualifications and, you know, your debt to income ratio and your loan to value and, you know, all the different criteria that makes you a good borrower in terms of a refi. A loan modification is almost the opposite. You need to not be a good borrower. Your property needs to be upside down. And we'll go through each one of these more in detail. The next one is a short sale. A short sale, the seller strikes a deal with their lender, or I actually strike the deal on your behalf, to accept less than you owe on the property in exchange for avoiding foreclosure. And so it is a renegotiation of your terms and having them accept taking less money and letting you off the hook. Or a deed in lieu. That's where you actually just give the property back. And also it's to avoid foreclosure. It's to avoid them taking the property back, which is worse on your credit. And just worse, I think, on people's psyches, because, you know, this is a renegotiation and it's a cleaner transaction than just letting them take it. So how do you figure out what you want to do? Well, first question is to ask yourself, do you want to keep the house? Now, that's a bit of a loaded question. Really, the question more is it a good business decision for you to keep the house? Because if you ask yourself, do you want to keep the house, you know, emotionally, yes, you might want to keep the house. But, you know, is it a good business decision to keep the house? I mean, if it's your primary residence, then of course it can be more of an emotional decision. Your kids grew up there, you know, you want to live there, you'd have to go find a rental anyway. And so it makes it more of not just a business decision, but just looking at, you know, the pros and cons. If it's an investment property, it really should be just a business decision and trying to separate your emotional responses from it. Okay, who's your lender? Not just who's your lender, who's your investor, because your lender almost definitely does not own your loan. 95% of the time there is an investor who owns your loan. It could be Freddie Mac, it could be Fannie Mae, it could be any of the really big banks, it could be private hedge funds. There's all sorts of investors that could own your loan, and the lender is just your servicer. And does your lender or your investor do loan mods on investment properties? They may tell you they do, but then they keep giving you no, 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 because they really don't. Is there a refinance option? Can you actually refinance? What are your financial circumstances? Can you afford repairs, vacancies, negative cash flow, all of that, if things aren't going well? Like I said, I did it for a year and spent $50,000. I didn't really even think about it. I just kind of, the bills came in and the mortgage came in and the checks went out, and that's just what I did until I realized that, it cost me $50,000 that year. And I'm telling you what, I really wished I would have had that $50,000 back, because it netted me nothing. I ended up getting rid of all those properties. What's the area? Are you upside down? Is it in an area that's going to rebound? What's the vacancies like? I have a lot of clients that just keep finding that they can't keep the property rented, or if they do, their tenants don't pay their rents. Okay, do you have a verifiable financial hardship? Now, I am very creative, and you may not think you have a verifiable hardship, but I have been able to help people who have high income and didn't think that they had a hardship, and I've still been able to work it out for them. If you have rental property, we can figure out a verifiable financial hardship. Do you have vacancies, repairs, taxes? Anything that's challenging is a financial hardship. Okay, and what's the effects on your credit and taxes? And after looking that over, are you willing to take the consequences? Because there will be consequences with those. Your credit is, the good news is, I'll tell you, after doing 11 short sales on my properties over the course of 2 years, it only took my credit really 1 year to bounce back. My FICO score went back to 720 after 1 year, and I was able to increase my credit card limits, get new credit cards. I bought a car. All of this after 1 year. Now, yes, of course, I could still not buy a property, but I just bought a new home now, and it's after 4 years. But I just bought a brand new primary residence, and all is well. So it does rebound, and it's not the worst thing in the world. And the taxes, I am not a tax professional, so I'm not going to give you any tax advice. All I can tell you is that we never had to pay a cent in any debt forgiveness or income property or any income from the repercussions of our short sales. We never had to pay a dime on it. Our tax accountant was very creative and was able to offset any of what they call, the 1099 income. Any of that was offset by all the expenses that we've had over the years with our properties. Okay, so we're looking at a loan modification, and the best success is on a primary residence. The lenders are more lenient on that. You do have to have a financial hardship. There's a financial worksheet, and it's generally based on 31% of your gross income. And so if we go over it, I'll be able to tell you pretty much what your new payment is going to be and whether you're going to qualify or not. Because it needs to be a sustainable loan to the bank. Like if your income is $1,000 a month, let's say your payment right now is $1,500. And you're only making right now $1,000 a month. You know, you got laid off and you're on unemployment or whatever, and you're only making $1,000 a month. Now, if we're looking at 31% of that, that's like $300, you know, $3,100, $310 a month. If the bank is used to getting like $1,500, they're not going to settle for $300 a month, and that would be including your taxes and insurance. That would not be a sustainable loan to the bank, and so that's not going to work. They're going to say your income's too low. So I'll be able to help you with that and tell you whether you're going to have a possible success with a loan modification or not, and what you need to do in order to see what you can do to change your situation. Of course, there's lender forms. I explain the entire process to you. And the good day is when you actually get that trial modification in the mail, they will tell you how much your payment is. And generally, after 3 months, if you make your payment on time, and if your situation doesn't change, then they'll make it permanent. And that's the good news. A short sale. So, of course, with all of this, with your loan mods too, or your short sales, you have to be behind on your mortgage payments. And then we list the property in the area. What I do is I get a realtor in that area, or if you're, you know, if you love your property manager and if they do sales, then we could utilize them as long as they're going to be a good team player. But otherwise, I have, you know, myself and Marshall Reddick have great realtors in most of the areas that, you know, you're going to have properties in that we've used before and that work with us very well as a team to get it done. And so we have them list the property, and then of course we need to get an offer, and I'll monitor that whole situation and make sure that the price point is good, have them lower the price point if necessary. You know, I'll send in a package to the lender if it's appropriate and have them get us what they think that the price point should be. And then we'll send in a full short sale package and, you know, a closing statement to the lender once you have an offer. We'll explain your verifiable financial hardship. We'll send in, you know, I'll have you send me all of your paperwork. I will review it all with a fine-tooth comb before it goes into the lender. I'll help you with it all. And then they're going to go ahead and do their BPO, which is a broker's price opinion, which is this form of appraisal that the lenders mostly do. And that's when they come up with value. And that's what they're going to base their decision on, for the most part, is the value. And so I work very strongly with the realtor to help them influence, if there's any way to influence that appraisal that the lender orders, you know, do that, so that we point out anything that's wrong with the property, we point out the comps in the area, you know, and we really try and get it as low as possible so that to justify whatever offer that we have on the table. And then the negotiations with the lenders happen. You know, I'll negotiate with all liens. Of course, if there's 2 liens, it makes it more difficult because they both have to agree. The first lien generally gives the second lien a particular amount of money, and then the second lien has to accept that. And that can be a tough negotiation sometimes, but I'm very good at it, and I always work it out. Then there may also be an HOA lien. Might be behind in that or on your taxes. There may be a contractor's lien. I've had all of it. And so I negotiate with all of that. Then the lender may come up and say, you know, this price point isn't good enough, and they'll counter. And so then I go back to the buyer's agent and counter to the buyer's agent. And generally what happens is, they go down, they go up, everybody does a little bit of movement, and we meet somewhere in the middle, and then we have a successful negotiation, and then you'll get an approval. And on the approval, what we're looking for is to make sure that there's no seller contribution, that there's no promissory note, and that they're dismissing any rights to come after you in the future. That will all be on the approval. Okay, let's look at a deed in lieu. With a deed in lieu, the property generally needs to be listed for 90 days with no acceptable offer. That isn't fully so, and Fannie Mae actually sometimes will do it sooner than that. It usually only has to have one loan on it, because if you're going to give it back to the bank, there can't be a second lien on the property, although I've been able to negotiate it so that the first lien actually pays off the second lien, like $6,000, and the second lien accepts it. And I've had that happen too. So it's not a hard and fast rule, but the investor, whoever owns the note, must be willing to accept a deed in lieu. Also, you need a verifiable hardship. You have all the financial forms in the package, and I'm going to follow up weekly and make sure that it all is moving forward. And then the good day comes when the attorney package gets sent to you, saying sign here, and we're going to record it and get this out of your name and get it back into the lender's name and get it out of your hair and off your books. And so that's a good thing, but I'm making it sound a lot easier than it is. It's not that easy, and it's not that hard. It just takes a lot of clear financial work, and that's one of the reasons of using a professional like myself. I cannot tell you how many people have come back to me after they've either tried it by themselves or even with just the realtor in the area, and they've come back to me and they said, oh my God, now they want a $20,000 cash contribution from me at closing. And, they were trying to avoid my fee of $3,000, and now they have a $20,000 cash fee at closing because they didn't do the financials in a way that was user-friendly for them. And, the realtors aren't going to do that for you. They're not going to know how to help write up your financials in a way that mitigates your loss. They'll just give you the forms. So anyway, it's certainly worth having a professional like myself. Why hire me? Well, we just started getting into that. So I have years of experience and a great track record. The statistics on short sales success is that about 40% of short sales actually go through. My numbers is 98%. Out of about 300 short sales, there's only about 5 or 6 that didn't go through. And through absolutely no fault of mine. But generally, most of those was because we couldn't find a buyer and the realtor wouldn't take a deed in lieu, or because the lender was playing such hardball that they wanted way, way more money than the property was actually worth. And we fought and fought. One of them, we fought and fought and fought and sent them appraisals and sent them repair bills and sent them everything, and they wouldn't budge. And we could not get a buyer to pay this exorbitant price that the lender wanted for it. So that was a bit of a challenge. But out of 300, I think we've not completed on 5. I'd say that that's really, really good. And some of them have just been like pulling a rabbit out of the hat. I mean, just magic. So I manage the entire process and keep it moving. I'm detail-oriented. You're not going to have any surprises at closing. I understand exactly what the lenders want. And not just that, you know, like I said, they like dealing with me. I keep you informed every step of the way. I will get you the best possible outcome. I'm service-oriented, tenacious, honest and direct, empathetic, and I love doing this. Most realtors, I'm a realtor and a loan professional, a mortgage professional, and most realtors do not like doing short sales. They start groaning when they get a short sale. A lot of realtors won't even take short sales, but I specialize in them because it's part of my personality. I just really do well with negotiations and with talking to lenders, and I would rather do this than go out in the field and show houses, although I do that. You know, I would rather do this and stay here in my beautiful office overlooking my garden and sit and talk to the lenders all day, or sit outside in my patio and talk to the lenders all day. So this is my preference, and I like doing it. Payment is due at closing. If you don't agree to the terms of the short sale or the loan modification, you don't owe me anything. So, of course, I only take the files that I know are going to close. And so if you become my client, you know that you have a 99% chance of closing. And yes, I create happy clients. So this is just a testimonial from one of my clients. You know, Linda, thank you for your help the past few months trying to short sell multiple properties in different states with numerous banks involved. Seemed like an overwhelming task. After hearing you speak, I decided to try your services before just letting the properties go into foreclosure. You did an amazing job working with the banks, realtors, property managers, and county employees. You made the whole process easy on my end. After my initial consultation with you and emailing you the necessary documents up front, the whole process seemed effortless, at least for me. I simply had to sign the closing docs and a large weight was lifted from my mind. The valuable service you provided is greatly appreciated, and thanks to you, I can sleep easier at night. So this is really what I hear from all of my clients. You know, this is not an isolated incident. Every step of the way, all of my clients saying, thank you, I'm so glad I have you. I can't imagine going through this without you. And it makes me feel great. It just makes me feel really good being able to do this sort of service and make this sort of contribution to people who are going through a challenging time. And let's see, is one more. And you can just read this on your own. Well, I'll read it. Okay. Hi, Linda. Just wanted to thank you and your husband, Alex, for the expertise that was provided in the handling of our Arizona short sale. The transaction was completed within 2 to 3 months' time. It took a burden of debt off our shoulders. I highly recommend the use of Linda and Alex Robinson's professional experience in short sales. So I have about 100 of these, and oops. Okay, I guess we're going to go to questions next.
Thank you so much, Linda. I know anytime we have this webinar or talk about short sales, I learn so much after you talk from your expertise, and it goes to show with a 98% success rate, you definitely are the best in the business out there. Everybody on the screen there is Linda's contact information. I highly suggest that you write that down. If you, your friends, your family, anybody has any need for Linda's services, whether it's a question or have a property that's underwater, write down that number. It will be invaluable and could save you a lot of sleep at night as well, as Linda touched on a personal level too.
And I'm happy to give everybody a free consultation and go over your entire portfolio with you. You know, so So there's no real reason, there's no obligation, and there's no reason not to call if if you have any questions or any curiosity about it.
Exactly. So write down that number, write down that email address, and if you happen to lose that piece of paper that you're writing it down on, give me a call. I'd be happy to connect the two of you. Throughout the presentation, we had some great questions, so I'm going to read off some of them. If you folks do have additional questions, go ahead and type them in the chat bar, and I'll be sure that Linda goes ahead and answers those questions. So the first one for you, Linda, is from our friend Mike. He's saying, on short sale and REOs, what percentage of fair market value typically do they accept?
Generally, they'll accept 90%.
Okay, great.
That's pretty much a rule of thumb, but not every investor uses that rule of thumb. But that's generally what we can get is, 90%. Sometimes I can get it lower than that, but that's the rule of thumb.
Okay. And this one comes from Stephanie, and I think this is going to resonate with a lot of individuals since a lot of people own investment property themselves and they have a tenant in place. So what happens if a tenant is in place in their property?
Yeah, that's a great question, and I usually talk about it, so I'm glad you brought it up. It really depends. Much of the time, I can get the tenant relocation funds from the lender, and that helps. I mean, as long as and I talk to them, or the realtor talks to them, or the property manager talks to them, whoever is going to be the best person to talk to them, and we let them know that we can probably get them the relocation fund, and that they have to be cooperative, and they have to still pay their rent, and they have to vacate by the closing date, and they have to leave the place in good condition. And so generally that works out really well. Sometimes, of course, it's an investor that buys the property, and they're happy that there's a tenant there, and the tenant gets to stay, and that works out really well. If I can't get them relocation funds, then, most of the time the tenants are going to be cooperative. If they still have a lease, though, then it can be a little challenging. But the property managers are usually pretty good with trying to find them another place and get them into it. And we've always seemed to work it out. But usually I can get them relocation funds.
That's great to hear. And then this one comes from Jensen, who says, how long does a short sale affect a borrower's ability to obtain conventional financing?
Yeah, that's going to be about 4 years. They say that, that sometimes it could be 2, and you have to have a really, really good reason for the short sale in order for it to be 2, like you lost your job, or it was an illness, a medical illness or something like that. Then sometimes they'll make an exception on it if it was just like one short sale or something. But if you've had multiple short sales, it's definitely going to be 4. And if it wasn't due to one of the really extreme reasons, then you probably can't get an exception on it.
Okay. Awesome, thank you. And it looks like this one's the last question of the night. This one's from Mary. And in your experience, do you see different lenders being more difficult to work with, whether it's the large banks like Bank of America or something like that?
Yeah, I mean, the large banks are actually the easier ones to deal with. You know, I have great success. A lot of people don't seem to not like Ocwen. You know, there's a servicing company. A lot of people seem to not like them. They're actually one of my favorite ones to deal with. You know, I work really well with Ocwen and Bank of America and Wells Fargo. The big banks are generally pretty easy because most of them will work with, there's a potential to get you into the government program, you know, the Home Affordable program, because they subscribe to it. It's the small banks or the credit unions that are the most difficult because you're dealing with an actual official in the, like the vice president. Like right now I have one from Mission Federal that I'm dealing with the vice president of the bank, you know, but she's a hard nose, and it's much more difficult because they keep most of their loans in-house, and so it's their money, and they're not going to get reimbursed by the government for, you know, taking less, and so it's a much more challenging proposition working with the smaller banks and the credit unions. But I do it, and I mostly get it done. And of course, it's challenging. Like I said, you know, if there are two loans, depending who the second loan is with, you know, sometimes it gets difficult because some second lenders who also aren't the big banks, you know, the smaller lenders, something can be quite difficult, and they just may not take the standard amount of money that most first lenders give them. You know, there's pretty standard amount of money that the first lender will give the second lender, and sometimes they won't take it. They want 20% of what's owed them, or they want the same percentage that the first lender is getting. They have all sorts of different formulas to some of these smaller second lenders. And sometimes I've actually had to work it out with the buyer, for the buyer to actually pay part of what the second lender needs to get. And I've always been able to do it. And so, you know, the negotiation is challenging sometimes. And I work it out with the buyer so that they may pay a little bit less for the property, but then pay an additional amount of money towards the second lien or something, so that we can work it out for everybody and get it done. So I'm very well versed in all of it.
Well, thank you so much, Linda. That looks like it concludes all the questions for tonight. There were
one thing I wanted to make sure to tell everybody is what my fee is that, you know, I charge a flat $3,000 if there's one lien and $3,500 if there's two. So it doesn't really matter how much the loan is or the property or whatever. It's a flat fee. And like I said, you don't pay it until we're at closing, and only if it works. So, you know, that's a very good proposition.
Yep, guys, that's the most important part. You don't pay Linda for her services unless she gets the deal done, and she is the best in the business. She will get it done for you to get you more sleep at night, you know, to help you make that business decision behind this solution to help you avoid that foreclosure there as well. So I really appreciate everybody's time. I know you were all hard at work today. Linda, thank you so much. Everybody, jot down this number that Linda, her cell phone number, and as well as that email. Here's my contact information. I would love to get to know more of you. I know I've spoken with about beforehand, but it's my goal to help you guys out to achieve financial independence. So at the end of tonight, I hope you guys all learned a thing or two about helping to avoid that foreclosure, and we will see you all on the next webinar or the live event as well. So thank you all so much again, and have a great rest of your night.
Good night, everybody. Thank you, Parker.